Welcome to the Golden Rules YouTube channel. Today, we will dive deep into a concept that everyone has heard of: compound interest. Many people praise compound interest as a miracle that makes money grow without hard work. But what is the reality? Is compound interest truly a magical tool for everyone? Or is it only for those who already have a solid foundation? In this video, we will analyze in detail, based on a logical outline, to help you understand better and apply it to your personal financial journey. Let's get started. 1. Compound interest is not a miracle. Compound interest, also known as compound interest, is a concept that Albert Einstein once called the eighth wonder of the world. The basic idea is that interest is calculated not only on the initial capital, but also on the accumulated interest from previous periods. For example, if you invest 100 million VND with a 10% annual interest rate, after the first year, you have 110 million. In the second year, interest is calculated on 110 million, yielding 11 million in interest, and so on. The result is that your money grows exponentially over time. However, don't rush to think that compound interest is a miracle that turns you into a millionaire overnight. In reality, compound interest requires two crucial factors: a large amount of capital and a long time. With a small amount of money, the initial effect is very slow, sometimes making you feel like you're pouring money into a black hole. Imagine you only have 10 million VND to invest. With a 7% interest rate, the average for safe investment funds, after the first year, you only earn an additional 700,000 VND, a figure not enough to change your life. It takes decades for the snowball to start rolling faster. Many people are swept away by success stories on social media where millionaires talk about how compound interest made them wealthy. But they often omit a key detail: they started with large capital from inheritance, successful businesses, or high salaries. For the average person, compound interest is like a seed. It needs persistent nurturing to sprout. If you expect quick results, you will be disappointed. Instead, consider compound interest as a supporting tool, not the sole solution. It helps make your money work for you, but only if you provided enough fuel initially. Moreover, compound interest doesn't always work smoothly. Inflation fund management fees and market fluctuations can erode profits. In Vietnam, with an average inflation rate of about 4 to 5% per year, your real interest rate may drop to just 2 to 3% if you invest in bank savings. Therefore, compound interest is not an automatic miracle. It requires understanding and risk management. If you're a beginner, start by learning how to calculate compound interest using the formula A, P, 1 plus Rn Warnit, where A is the final amount, P is the principal, R is the interest rate, and is the number of times interest is compounded, and T is the time. Practice with online tools like compound interest calculators on financial apps for clearer insights. In summary, compound interest is a powerful mathematical principle, but it's not a miracle for everyone right away. It requires patience and a solid foundation. If you're in the early stages, don't be discouraged. Keep reading to see how to overcome challenges. 2. The scale of capital determines effectiveness. Now let's delve into the core factor: the scale of capital. Compound interest works by multiplying the initial capital, so the size of the starting capital determines the growth rate. Let's take a specific example to illustrate. Suppose you invest 2 million VND, about 100 USD, with a 10% annual interest rate compounded annually. After the first year, you earn an additional 200,000 VND in interest, a small amount, perhaps only enough for a family meal. After 10 years, your money will be about 587,000 VND, meaning it has grown 2.5 times. It sounds decent, but in reality, with inflation, the real value of this money may not increase much. You still have to work hard to live. In contrast, if you have a larger capital, say 2 billion VND, about 100,000 USD, with the same 10% interest rate, you earn 200 million VND in the first year, a passive income sufficient to cover a comfortable life for many families. After 10 years, the amount will reach about 5.187 billion VND, creating a huge difference. This is why compound interest is often seen as a tool for the rich. Those with large capital can leverage it to generate passive income while the poor or middle class struggle with slow growth. Think of Warren Buffett, the investment king, who amassed enormous wealth through compound interest. But he started with capital from small businesses and smart investments from a young age. Most of his wealth was accumulated after age 50 thanks to a large initial capital. In Vietnam, you can see successful entrepreneurs like owners of retail chains or real estate who use compound interest from stock investments or ETF funds to multiply their wealth. Compound interest benefits those with more money because it creates a leverage effect. With large capital, you can diversify investments into stocks, bonds, or real estate, where interest rates can exceed 10 to 15% if managed well. Conversely, with small capital, you're often limited to safe options like bank savings. 5 to 7% interest and transaction fees can eat up the meager profits. To illustrate further, let's calculate with a tool. Assume an 8% interest rate, the long-term average of the Vietnamese stock market. With 10 million VND initial capital, after 20 years, about 46.6 million. But with 100 million VND, the figure is 466 million, 10 times the initial capital, but the actual profit is much greater. This shows that the scale of capital not only determines the speed, but also the ability to withstand risks. Large capital allows you to weather market downturns without withdrawing funds early. Of course, not everyone is born with large capital. But this section emphasizes don't dream about compound interest while neglecting to build capital. Move on to the next section to see the challenges of starting from zero. 3. Challenges of starting small. Starting with a small amount is the reality for most of us, especially in Vietnam, where the average income is only about 5-10 million VND per month. However, this is the most challenging phase for compound interest. Let's analyze why. First, slow growth. For example, you save 10 million VND, about 500 USD, with a 5% bank interest rate. After the first year, you only gain an additional 500,000 VND, a figure not enough to motivate. After 5 years, the amount is about 12.76 million, an increase of less than 30%. Compared to the skyrocketing cost of living fuel food, you may feel like you're running in place. The snowball effect only becomes noticeable after 10 to 20 years when interest starts accumulating on interest. Second, the psychology of discouragement. Many people give up because they don't see quick results. According to surveys from Vietnamese banks, over 50% of savings accounts are withdrawn early due to unexpected expenses or impatience. You might think, I'd rather use that money for shopping or risky investments to earn faster. But in reality, risky investments often lead to losses, like recent cryptocurrency scams. The third challenge is time. Compound interest requires persistence. If you withdraw money midway due to emergencies, job loss, illness, the entire process is disrupted. In your 20s, 30s, you have a long time ahead, but a busy life with work and family makes it hard to stay consistent. Moreover, economic fluctuations like the COVID-19 pandemic can lower interest rates, making growth slower than expected. To overcome this, remember that great things start small. Billionaires like Jack Ma or Pham Nhat Vuong began with limited capital but persevered, set small goals, track progress monthly via apps like Misa or Excel. And don't forget, compound interest is not just about money but also a lesson in discipline. 4. Approach for beginners. If you're a beginner, don't worry. Here are practical ways to leverage compound interest from a small amount. First, save regularly. Apply the 50-30-20 rule: 50% of income for essentials, 30% for wants, 20% for savings and investment. For example, with a 10 million VND month salary, save 2 million. Increase income by freelancing or learning new skills, like programming marketing. Second, keep costs low. Avoid bad debt like high-interest consumer loans. Use credit cards smartly to earn points, but pay off the balance monthly. Third, invest continuously. Don't interrupt. For example, investing 5 million VNDE month, about 200 USD at 8% for 30 years, can yield about 7 billion VND, 280,000 USD. If increased to 10 million VND month, 400 USD, the figure is 14 billion 560,000 USD. Use tools like VN30 ETF funds or blue chip stocks via the stock exchange. Initially, the amount you put in matters more than the return. Focus on accumulating principal rather than chasing high-risk profits. Use apps like FinHey or VCBF for automated investing. 5. Long-term strategy. The long-term strategy focuses on building principal. Start small, save 10-30% of income and increase as your salary grows. Diversify: 60% stocks, 30% bonds, 10% gold. Compound interest brings financial freedom, early retirement travel, or pursuing passions. But it requires patience. Think 10, 20 years ahead. 6. Conclusion. Compound interest is a powerful tool, but not instant. Success comes from discipline, regular investing, and long-term thinking. Start today, no matter how small, to build a solid future. Thank you for watching. Like, share, and subscribe to the channel for more financial tips.